May 6, 2010, a little after 2:30 in the afternoon, the US stock market simply falls out of the sky. In about 15 minutes, by some measures, close to $1 trillion in value is gone. And then, almost as strangely, it comes back. On trading floors, people are standing up, staring at screens, not quite believing the numbers. A share of one of the biggest companies in America briefly changes hands for a single penny. Another prints at $100,000. Nothing about those prices is real, but for a few minutes the machine accepts them anyway. Hundreds of points, gone and recovered, faster than any human could react because no human did. At first, everyone reached for the simplest explanation. A fat finger. One trader fumbling the keyboard typing billion where they meant million, and knocking the whole market over by accident. It's a comforting story. One clumsy mistake. But the data didn't fit. There was no single fat finger. The world needed someone to blame. And eventually they found him. Not a bank, not a hedge fund. A 30-something trader working alone in his parents' house in a quiet corner of West London. The press gave him a name, the man who crashed the market from his bedroom. There's just one problem with that story. The official 400-page report on the crash doesn't mention him, not once. So, how did one man's name end up on the biggest one-day drop in market history? And what actually happened in those 15 minutes? The answer is stranger than a villain. Because the closer you look, the clearer it gets. Nobody was driving. To understand how a market falls off a cliff and climbs back before the closing bell, you first have to understand something almost nobody thinks about: who or what you're really trading with. Picture buying a stock. You probably imagine a person on the other side choosing to sell to you, a human decision meeting yours. That picture is about 15 years out of date. The other side is almost always a machine, a market maker. Think of the change booth at an arcade, always open, always willing to swap your cash for tokens or your tokens back for cash. A market maker does that for stock. Its job is to quote a price to buy and a price to sell on nearly everything, nearly all the time, and earn a tiny sliver on the gap between the two, millions of times a day. That's the quiet miracle that makes modern markets feel effortless. There is always someone to trade with. You hit a button and it just worked. Many of these machines are high-frequency traders, algorithms that see a price and react in millionths of a second, faster than a thought, faster than you can finish this sentence, thousands of times over. And here is the part nobody puts in the brochure, that always someone to trade with is a promise no one is required to keep. A market maker can pull every order it's showing instantly, for any reason or no reason. The depth you see, all those buyers and sellers stacked up ready, isn't a law of nature. It's a crowd of algorithms agreeing to show up, and algorithms only show up when the math looks safe. We have a comfortable word for that depth: liquidity, the ability to buy or sell without moving the price. On a normal day, it feels solid, permanent, like water in a pool. But it's closer to a crowd than a pool, and a crowd can leave. So the real question, the one May 6th answered the hard way, is this: what happens when the math suddenly looks dangerous? When every machine at the very same moment decides to step back from the table? This is where our man in the bedroom finally gets a name. The name that ended up on the biggest one-day drop in market history, Navinder Sarao. The tabloids would give him a catchier one, the Hound of Hounslow. He wasn't a Wall Street insider. He was a self-taught trader from Hounslow, a working-class suburb under Heathrow's flight path, who never really left home. For years, he traded one of the most important contracts in all of finance, the E-mini S&P 500. That's a futures contract, basically a standardized bet on where the market goes next, and this one moves with the entire US market. And he got very, very good at one particular thing. He found a way to lie to the machines. It's called spoofing. In plain terms, it's bluffing. You pretend you're about to dump a huge pile of stock so everyone else panics and backs away. And then you never actually sell. The mechanics are almost insultingly simple. You place enormous orders to sell, far bigger than anything you actually intend to trade, and you stack them just above the current price. To every other algorithm watching the order book, That looks like a wall of sellers about to shove the price down. So they do the rational thing, they flinch, they lower their own bids, they get out of the way. And the instant they flinch, you cancel. The wall vanishes. It was never real. Those orders were never meant to be filled. Regulators call it layering. And in 2010, the US passed a law making it explicitly illegal. But the technique was simple enough to run from a laptop in a bedroom with the right software. Here's the detail that makes it real. On one single day, investigators later pulled apart. Serao's orders were modified more than 80,000 times. And of all those orders, the giant walls flashing in and vanishing all day long, the number that actually traded was 81. He wasn't predicting the market, he was nudging it, feeding every machine in the building a fake picture of supply and demand, and quietly keeping the difference. Over a few years, by regulators' count, tens of millions of dollars. Now hold that image, a fake wall of selling pressure flashing on and off, and let's go back to the afternoon of May 6th. The day was already ugly before anything broke. Europe was in crisis, fear was in the air, and US stocks were down more than 4% before the strange part even began. Picture a dry forest at the end of summer. Parched, tense, the kind of place where a single spark can race out of control. That's the state the market was in. Thin, nervous, prime. All it needed was a spark. Then, at 2:32 in the afternoon, one large trader, a mutual fund firm called Waddell and Reed, decided to sell 75,000 E-mini contracts, about $4 billion worth, as a hedge. Selling $4 billion is normal. How they sold it was not. They handed the keys to an algorithm. One blunt instruction: keep selling at 9% of recent volume, no matter the price, no matter the time. No human at the wheel. And here's the thing, 4 billion sounds enormous, but it was barely 1% of the day's trading. On a calm day, the market would have swallowed it whole. A careful version of that exact order had once taken more than 5 hours. This one emptied in about 20 minutes. It poured $4 billion of selling into a market that was already thin, already nervous. And the machines did precisely what machines do. They saw selling, they saw risk, and they stepped back. The liquidity we talked about, the crowd, turned for the exits all at once. What happened next, the regulators gave a strangely playful name: a hot potato. In 14 seconds, high-frequency algorithms threw 27,000 contracts back and forth between themselves, almost half of all the trading happening, while barely buying anything at all. Not investing, not deciding, just passing the same hot potato hand to hand as the floor dropped out beneath it. With almost no real buyers left, the prices went somewhere no human would ever send them. A blue chip company for a penny, another for $100,000. More than 20,000 trades across hundreds of stocks landed so far from reality that the exchanges later did something almost unheard of. They reached in and canceled them as if they never happened. And then it stopped. Not because a person stepped in, because a machine did. An automatic 5-second pause on the futures exchange. A circuit breaker the CME called stop logic. 5 seconds. That was enough for buyers to creep back, and within minutes, most of that $1 trillion had returned. So, where does Serao fit? That afternoon, his spoofing program was running for hours, adding, by regulators' estimate, up to $200 million of fake downward pressure to a market already on the edge. 5 years later, that's what they would charge him for. But listen to the careful words they chose. Not that he caused the crash, that he contributed to the conditions that made it possible. The official report written months afterward blames the price-blind algorithm and the machines that fled. It never names him at all. And the academics who later took apart every trade agreed on the uncomfortable part. The high-frequency machines didn't start the fire, but when it caught, they poured on the air. The honest version is stranger than the headline: a dry, nervous market, a price-blind sell order, a swarm of machines sprinting for the same door, and yes, one man in a bedroom leaning on the scale. No single villain, just a machine doing exactly what it was told. Afterward, the regulators had an awkward problem. You can't fire a market maker for losing its nerve. You can't sit an algorithm down and reason with it. So they did the only thing you can do with the machine that won't stop on its own. They built a kill switch. Circuit breakers, automatic pauses that trip when a stock moves too far, too fast. They started just weeks after the crash and grew into the guardrails that still watch every major stock today. The market's answer to no humans in the loop wasn't to put a human back in. It was a switch that flips when the machines go too far. As for Sorrell, it took years to find him. And when they did, he wasn't in a glass tower. He was in the same childhood bedroom he'd been trading from the whole time. Prosecutors said he'd made around $40 million. He admitted to about 13. Either way, almost all of it was already gone. The spoofer, it turned out, had been spoofed, conned out of his fortune by fraudsters and fake investors. He pled guilty to spoofing, and because he cooperated extensively, and because he was diagnosed with Asperger's, he served no prison time beyond the few months he'd already spent waiting. His sentence, a year of home detention, back in that same house. But the part worth keeping isn't the man, it's the machine he was poking. We didn't replace human traders with faster humans. We replaced the decision itself with code. Code that quotes, reacts, and retreats in millionths of a second with no one actually steering. Most days that's invisible. It feels like a market. It feels like there's someone there. Until 15 minutes in 2010, when there wasn't, when $1 trillion could vanish and return before the afternoon was out, and the closest thing to a person we could find to blame was a guy in a bedroom in Hounslow. The machine doesn't care that none of this was anyone's plan. It doesn't care at all. It just runs. That was the trade we made when we handed it the wheel. And we are still, right now, living inside it. This was the second edge dive look at the invisible systems quietly running modern life. The first one's on screen now. The billion-dollar name that still works a job.